Hello, everybody. Welcome to Friday, another Talk Money with Tom show today. I'm joined by Eason, another one of our advisors. We're here to try to help you have a more successful retirement. We do that through really kind of a question and answer session. So we get questions lots of different ways. One way is that you can send in a question to that email address that's listed right here, the Ask Tom at talkmoneywithtom.com. There's a chat box here. You can put in your chat if you'd like to, ask the question that way. We get questions sent in during the week. And then sometimes I get questions that come in during my strategy sessions with my clients that I want to share with everybody because I think they're important for everybody to know. So again, the objective is to help you have a more successful retirement, and we kind of focus on three areas: retirement planning, investment management, and tax planning. We feel that the more you know about those three areas, the more chance you have of a more successful retirement. So if you'd like to continue to, get the content, we put out 1-2 videos every single day on this channel. You can subscribe to the channel, hit the subscribe button. You can hit the little bell if you'd like to get notified when we put something on there. And again, the whole objective of this is purely education along those lines. So really excited to be able to be here today and to be able to try to help out as far as that goes. But I'll start off like I usually do with just a little summary of what I saw in the stock market this week. Was again another interesting week like we have been having quite often recently. Started off the week really well. Market continued up its uptrend that started last week until we hit yesterday where Meta Platforms, which is formerly known as Facebook, had a really bad report. They had some of their subscribers drop, which is the first time that's happened in I think in their history, but certainly in a long time. They talked about the Apple privacy concerns creating $10 billion less in revenue. They lost $10 billion on their metaverse investment so far. Investment into that's going to take a while, and their guidance was a little bit more poor even than their actual results. And so we ended up yesterday with the largest single dollar loss for any stock in history. $232 billion disappeared from Facebook shareholders, which is kind of incredible. But I thought what's more incredible, though, is that it kind of went through a lot of different companies. I mean, semiconductors were coming down and all these different areas didn't make a lot of sense to me, because when you look at their report altogether, what you would be looking at right there is company specific issues. When I look at these company earnings, I'm really, really trying to figure out what's causing their, rise or fall, and especially in relationship to the economy. So is the economy doing better or is the economy doing worse? And the reason is because if you look at the stats, it's very important. We get lots of these small downturns. The average downturn without a recession is negative 15%. So that's kind of normal. They definitely happen. The average downturn, if you have a recession at the same time, is negative 36%. And the recovery times are dramatically different as far as that goes. So really not that wildly concerned about the 15% downturn, but definitely want to know about the 36% downturn with the longer recovery time. So when I look at what happened with Meta Platforms yesterday, I'm looking at that thinking, is this an economic event? Is this something that the economy is causing this problem? And my opinion is definitely not. This is a company specific event. So that's kind of interesting as far as that goes. And then this morning we had a jobs report that came out. We ended up with 467,000 jobs created in January. The expectation was for 125,000 jobs. So on the face of it, normally that's considered a good thing. More jobs, right? And we even have more pay because pay has been coming up. But when you talk about the stock market, traditionally in an environment like this, when you have a lot more jobs than expected, it scares the stock market because we're in a situation where the Federal Reserve is starting to tighten up money supply. And if you have a lot more jobs than expected, that can mean that the economy is growing even faster than expected, and that allows the Federal Reserve to get even more aggressive. And when they get more aggressive, they can slow down the economy even faster, and that can ultimately affect earnings, which ultimately affects the stock market. So a lot of times you will see these job reports like this in an environment like this, where we're already kind of at a full, economic growth situation, be a negative. And we did see that this morning. We saw some drop off, early in the morning when the report came out. But I have another look on this, and maybe the market does now too, because the S&P 500, as we sit here, is up, about 1% or so. And so, because one of the things that's happening now, this is not the standard situation where more jobs equals, faster, a more aggressive Federal Reserve, because what the Federal Reserve is really looking at here is inflation, right? It's a dual mandate: full employment, they feel like they're there, and then fight inflation. And that's what they're working on now. But even the Federal Reserve has said very clearly that there's two parts of fighting inflation. Number one is to try to slow down demand, which they have some control over by raising rates. And the other part is to try to increase supply. And that's one of the other big issues we're having right now, right? We have these supply chain constraints. And so one of the problems with the supply is employees having enough people to do what needs to be done. So I'll give you an analogy. Let's say you have a restaurant. You have a line out the door of people, trying to get into your restaurant, but you can't do a full 100% of your tables in that restaurant because you can't get chefs and waiters and things like that and waitresses. So you'll only do 75% of your tables. And so there's a supply constraint there, and the line stays out there and such because there's a demand. And what happens then is, as a restaurant owner, maybe you end up having to pay more for your, employees, but you are able to pass that along as higher prices to that high demand that's sitting outside the door. Well, then if all of a sudden a lot more people come out and start taking the jobs, and now you can do all of your tables, maybe the line outside starts to shrink down. The demand is met essentially by having more tables because you have more waiters, waitresses, and chefs and what have you. So I think a part of this is different because this is a pandemic and we've had troubles getting people out into the workforce. So if you see 467,000 jobs created in January, in the middle of the Omicron spike, when we only expected 125,000 jobs, I think that has a positive. I think that starts to help the other side of the inflation story, which is really the supply chain side of the story. And I gave you a restaurant analogy. You can apply that to a lot of different types of businesses. And that's been my premise from the get-go, again, is that the first half of this year will be, trying to help that supply chain side. My hope is that it's better, at least somewhat so, for the second half of the year. That can help inflation, allow the Federal Reserve to be more flexible. Stock market would love that, more flexible language, at least coming from the Federal Reserve, because right now they're talking, quite strictly. So that's what's going on. I still think the basics are here. Economic growth is happening. Earnings are fantastic altogether, ignoring Metastock and a few others. Google reported this week, fantastic numbers. Advanced Micro Devices just blew it out of the water and had a huge run up after their earnings announcement. Amazon came in last night with really good numbers. The economy is doing fantastic. These companies are making profits. They're exceeding expectations, and the earnings growth is higher than expected by far. So the market's going to continue to adjust that. And again, it's very difficult for me to imagine a recession happening here in the short term, especially in an environment where we have this type of growth in the earnings. And if we don't have a recession combined with the stock market downturn, we're looking at more of the 15% variety instead of the negative 36% variety. And so, this little downturn we had could be over, could be recovering and coming back. It looks like it. I try not to get too excited about things because you never know what's going to happen. But definitely that one Monday, not this week, but the prior one, the 24th of January, where we had that huge reversal. So far, that's actually played out as a low point. So we'll see how that goes. But always interesting. It's interesting to know kind of how the stock market looks at something that might be different than the way you look at things. And so that's important to kind of understand as part of the educational concept of being able to become a good investor. I think that's important too. So look forward to seeing what's going to happen next week, and we'll talk to you then. All right, Eason, got some questions. Let's see what we can do to help answer some of these.
Yeah. So the first question has to do with the job reports. With unemployment came in at 4%, which was up from 3.9, but there's so many jobs added. How does that work out?
Yeah, so we had more jobs, and unemployment went up, right? That doesn't seem like it matches together. I think the issue really is, first of all, the unemployment number itself, the 3.9% now as a 4%. There's an awful lot of components that come into that. And so you theoretically could have higher unemployment because you have certain industries, let's say auto manufacturing ends up laying people off because they have to shut down their line for a while while they're waiting for more chips, or those types of things that can happen. The actual labor force can shrink itself also. You can get people that just decide they're not going to pursue the jobs any longer. Maybe they go back to school, or whatever it might be. So there's all these kind of strange variables that come into play into that unemployment report. Generally speaking, over a long period of time, and certainly since the bottom of the pandemic, we've seen higher job growth and lower unemployment, right? I mean, but you get these anomalies, especially a 0.1% anomaly, which is what we're talking about here, that happen just because of the way that these things are calculated. And I think one of the things about unemployment that isn't really talked about enough is what I call kind of real unemployment, just all of it. It's the people that are actually on unemployment, right now. Those people that have kind of fallen off the rolls of unemployment that are still wanting a job. Those people that are, I guess we call underemployed. So they, have a part-time job, but they really want a full-time job that pays more. That number can be quite a bit higher. And so focusing on unemployment itself, isn't that critical to me. It's that total kind of real unemployment factor as far as that goes. That has been shrinking also, slowly but surely. Things are getting back to normal. But part of that is some people just aren't, coming back to work. Maybe a two-worker family that now one of them is staying home with the kids, and they've just made adjustments to deal with that and such too. The pandemic created a chance for people to reset, and some people have, and maybe that comes back around and we get more and more people back into the workforce. But we did end up with a really high number of retirements. So kind of that baby boomer that was within 3 years of retirement retired now, or last year or what have you. And so that kind of shrunk that available workforce that's out there. And so a lot of open jobs, almost 11 million open jobs still. And so that's a part of the supply chain constraint. The jobs are open, there's not enough people taking the jobs, and so that demand is continuing to push the need for the product or service, and the employees aren't quite there yet. So that's partly why we're having this inflationary spike. So that's why today's jobs report's important. Yeah, so we'll see how that plays out. Yeah, but it's very, very interesting to watch. I think the employment part is critical.
Yeah, that's good to know. So with like these big job reports, does that mean wages are going to go up, and so because and then inflation in turn is going to kind of follow through with that?
Well, when you have a higher job report growth like this, theoretically, you have more people coming out to work, and the more people that come out to work, the less competitive the job openings are, theoretically, over a period of time. So, I mean, let's say, for example, if there's more people looking for work than there are jobs, wages could go down, right? Because it's basically the employer has a choice of people, and the new employees have no leverage, and the existing employees have no leverage either because there's no jobs open. So that's a recession. It happens all the time. In this situation, we've got the opposite. We have more jobs than we do people that want to take those jobs. So the more people that take jobs, theoretically, the less pressure that would put on increasing wages, if that makes sense. In my opinion, I could be missing something there in the economics of how that works. But I think, if I'm an employer and I've got all these people and they're asking for more money, and then I have some choices over here for people that will take my job at the price that I'm willing to pay right now, I might, take that person instead because they're cheaper, right? Theoretically. And so the more people that are looking for work, and that's how I kind of look at the jobs report, just that people accepted the jobs because there's 11 million open jobs. And so, people accepted the jobs as a whole. It's very specific, industry specific, and I'm talking in generalities, but yeah, it's interesting.
So this is a kind of a state planning question. if something were to happen to me, how does my family know where everything is and how to access any of my assets and benefits I might leave behind?
Okay, so this is actually really interesting because this is something we run across, and I actually had conversations with another friend of mine who's an advisor where the widow comes in, and the biggest problem they're having right now is just finding things. They don't know where it is. I remember specifically a case with a lady who came in to see me for the first time and brought in a grocery bag filled with envelopes, unopened, just different things that had come in that looked financial. And we sat there and opened them up during the appointment, and there was all of these dividend checks in there. Back when they used to send you the check instead of deposit it directly, this was a while ago. We actually spent 3 years in that case trying to find the assets. And so that's a really big deal. Theoretically, if somebody can't find your assets, it can be sent back to the state. So if you have some bank account over there and nobody knows about it, and you pass away, there's some period of time that has to pass, but that money can actually be surrendered back to the state. And apparently there is like billions of dollars that do get surrendered back to the state, which is kind of mind-boggling. So the question is kind of a before question. So I want to make sure that doesn't happen to my beneficiaries, correct? I mean, that's what they're asking.
Mhm.
So I think it's a great question. Actually, it's the right question to be asking so that your beneficiaries don't end up like these other situations that I've seen. I have seen some really good systems within my clientele where they will, put things together in one file cabinet or one file cabinet drawer or whatever, and they make sure that their beneficiaries know, hey, this is where I'm keeping everything, and I've got my accounts in here or what have you. In today's world, that could be electronic, right? And it doesn't have to be super sophisticated, even up to date with the latest statements. I mean, I have another case right now that I'm dealing with a woman and her daughter, and it's one of my clients. So they know where my stuff is, but then they keep getting these other issues coming in and they don't know what it is. And is this actually money or not? So, what you do want to watch, obviously, in that case, is the mail and that person's email address. But it would have been really nice if they would have had it in one spot and said, okay, here is where I have everything in case you need it. Um, One of the things I always try to encourage people to do is to kind of put it in one folder electronically so that all we need to know in the end is we got this account, this account, this account. Here it is. Here it doesn't need to be exact. Give me some account numbers, and then we can go out and try to figure out how to get it and get death certificates to that person, what have you. So I think that's the beginning spot. There's much more sophisticated ways. We have these vaults that you can put everything in so the beneficiaries can see the trust, can see your tax returns, can see the link. We can link in every single account you have into there, and you can give that beneficiary the password, right? So that that's all they have to do. Boom, password, everything's there. It's electronic. You can see values, you can see account numbers. Some people don't want to do that. They're afraid of putting all their stuff in one place. So everybody's got a different way of doing it. But in essence, I think that's one of the keys is just put it somewhere, let the people know where it is. That's it. And so, it's not that difficult to do, but it does happen where that goes awry, and your beneficiaries end up spending a lot of time trying to find the hard-earned money that you had put in there. So that's just kind of how it goes.
Yeah, and like I know there some people have some people have emotional issues with like having their children or their beneficiaries know how much money they have. And
Yes.
so just having, generic account numbers where what institution is, they don't really need to know the specific value of the account. They just need to know where the account is, where the money is.
Yeah.
So as long as they get that information and then they can access all your assets when
Yeah.
they need to.
Yeah, yeah, exactly right. No, that's actually the case I just talked about with this the wife and the daughter. Uh, he wasn't hiding the money, but he didn't, he was afraid that she was going to spend too much if she knew how much they actually had. So he kind of kept it secret. It's an old style concept I don't particularly agree with, but that's exactly what happened. But at the same time, he easily could have had just a list of account numbers and institutions without dollar amounts, just that he kept up to date. a one word document, so anything simple, and it would have made it a lot easier because they're literally mystified. They're getting these emails and they don't know what it is. Yeah, that's a good point. Actually, it doesn't have to be. You know, it, I would say most of the times within couples, for example, there is only one person that really deals with all the money. Not every time, but a lot. And so it's very difficult to have complete communication of where everything is all the time anyway. But again, just keep one simple document, something that shows, hey, this is where things are going, and this is the account numbers and institutional names. And you're right, once we have that, we can go out and we can prove that I'm Mrs. or Mr. So and so. Here's the death certificate, and that way we don't, so money doesn't disappear.
Yeah, and so if you're in the, or if you're in the predicament where you don't know where the assets are and someone's passed away, the best place is to keep an eye out for emails or any mail because
Yeah,
these institutions have to regularly report their statements to you
right.
in some form of delivery.
Yeah, I've been asked several times, isn't there a place where I can go and put in my, say, father's social security number and find all of his assets? And I said, thank goodness the answer is no, because somebody would probably take advantage of that. There is no central clearing database for, finding that I know of. And again, I think that's probably a good thing, just because of identity theft and different things that happen along those lines. So yeah, it's just a matter of, watching that. Generally speaking, all of the companies will eventually send something to the person that has the asset. Like I said, the case that I spent 3 years trying to find, that's what we did. She just kept coming in with those grocery bags full of envelopes, and we'd open them up. And so, that's one way we found. And then we kept tracking his email address because she kept it open, and she would, forward stuff to me that looked like it was financial. And we try to figure out if there was money there. We continued to find money in that case for 3 years. It was pretty incredible because not every company has to send something, on a consistent basis. Kind of depends on what happens and what type of investment it is. But yeah, it's that's one of the strategies. You can check with the state, I guess, for unclaimed assets. I'm not positive how that process works, but there's another aspect there that would be worth investigating.
So in the past, we've talked about expenses to plan for in retirement, but what are some expenses that kind of disappear when I retire?
That's a good one actually, because it's kind of interesting. There's quite a few. I've seen clothes go down. Because you can wear the same clothes more often, even if they get a little bit worn. You're not, showing up to work every day. Some of those clothes are cheaper. Sometimes casual clothes might be cheaper than the more formal clothes you might need for work. Of course, gas can go down. If you're not traveling back and forth to work, mileage and maintenance on your car can go down. The intervals between when you get your cars, might go down just because you're not using them as much, right? So that saves money. There's a whole host of things that happen. Oh, one of the big ones is sometimes people have, especially towards the end of their career, a lot of money going to the 401k, right? You can put lots of money in there, and all of a sudden now you're retired, you don't have that money going in your 401k any longer. And so, that's sort of a savings in a way, as far as that goes in terms of your cash flow. And so there's, bunches of things, but there's also a whole bunch of offsetting things. Now you're home every day. I know on the weekends, I'll probably spend more money on the weekends than I do when I'm at work. I'm too busy at work. On the weekends, I can sit there, I can go out, do things more often. And, if I'm not working, I could travel. I could spend money on travel. I can go out to eat more often, for example, theoretically. I'm free to eat every meal if I so desire. And so, just when you're really busy, sometimes it's a little harder to spend some of the money. Um, I haven't seen a huge differential over the years between what somebody's spending, prior to retirement versus what they're spending after. There's all these rule of thumbs, like 80% of your income that probably works, especially if you're putting 10, 20% away in the savings at the end. But something in that 80 to 100% of what you're already, already earning, you probably need into your retirement. It's not a big drop off. There's a lot of offsets, lots of things that you might, hobbies that you might do. So work is a bit of a hobby for me. I do that. I enjoy large parts of it. If I didn't have work, I'd probably have some other hobbies. Some of my hobbies are more expensive than others, and I've spent bunches of money on different things over the years. So if I had full time to do hobbies, I might spend more than on those than I would, right? So those are things that kind of offset the savings, at least in my opinion.
Yeah, one big expense that always goes away when you retire is your FICA taxes, which is your Social
Mm,
Security and your
yeah,
Medicare taxes.
yeah,
And once that disappears, that's an extra 7%
yeah.
of tax your expenses you're not paying.
That's right. Yeah, exactly right. That's a good point. Yeah, you're no longer contributing to that. Most of that's contributing to Social Security. You're potentially getting closer, if not already receiving Social Security, which is just the opposite. So, yeah, those it's a good point. There are some savings. Again, I just seen offsets for the most part, and it's good offsets. I mean, it's kind of fun. For most people, they'd rather travel and do hobbies and work on the yard and stuff than do some of the jobs that they have. Yeah, that's why retirement is generally considered a lot of fun by the people that I've met.
Yeah, and travel can probably you can stretch your dollar a little bit further probably
Mm-hmm.
because you don't have to stick to a schedule anymore.
Yeah. Yep.
You can take return flights on non-peak days.
Yes.
Return it on the middle of the week instead of returning on like the Sunday before work.
Yeah, that's a good point. Yeah, a lot of my clients travel in those. I mean, who wants to go out when all the families are out when you don't have to, when it's not as crowded? And that generally, yeah, you'll save money on the plane ticket. Almost everything you might save some money on. Yeah, that's a good point.
So this is another cryptocurrency question. Is crypto a safe investment in
Yeah,
general?
cryptocurrency is safe investment. Uh, in a pure answer, the answer, of course, would be no, just because of volatility, right? So when you look at safety, you look at volatility and you say, okay, this can go up and down, 10 or 18% in a day. That's not a safe investment by any stretch of the imagination. So what we call standard deviation, right? How much something can move around one or two standard deviations, and cryptocurrencies would probably be pretty high. Now, there's lots of them. I actually read an article. There was 1,000 new cryptocurrencies created in January alone. So it's pretty wild. I think that's one of the problems with cryptocurrency that they're going to run into is just there's too much supply eventually for the demand. But having said that, cryptocurrency is a different asset class. And theoretically, over a period of time, you might get some diversification benefit out of cryptocurrency. And so diversification increases safety, right? We haven't seen it completely yet. We saw, for example, the market kind of peak out here in November and come down. 24th of January was the interday low, and in that time frame, I think Bitcoin lost roughly 50% or something. So it actually went down with the market. So it kind of correlated with the market as far as and you want some discorrelation where it's kind of maybe not going down as much. Like bonds went down, but didn't go down as much. So at least there's some discorrelation there as far as that goes. So, but that'll be interesting to see how that plays out. Does it create, people use gold and silver, for example, for discorrelation, bonds for discorrelation, that kind of stuff. And some bonds are more, not as correlated as much as others. Treasuries tend to go the opposite direction of stocks in a downturn more often than not, but that kind of stuff. So cryptocurrency, that's it's been talked about a lot as a possible diversifier. If it does become one that you can actually rely upon, then that would actually potentially increase the safety of your overall portfolio. So you can sometimes add something like commodities to a portfolio that has a higher standard deviation and lower the standard deviation of your portfolio. So that if that starts to happen, that's how it would become a safe investment in that regards. But purely by itself, looking at standard deviation, yeah, of course it's very high. So it wouldn't be considered a safe investment by itself. But it could be part of a portfolio at some point. Haven't seen it yet, but could.
So can you explain how standard deviation is like when you compare the volatility of investment? Can you kind of explain that in a little bit more of a simpler terms?
Yeah, real simple terms. You can have two investments. They both make 10%. And one has a standard deviation of 5%. And another one has a standard deviation of 10%. So the one that has standard deviation of 5%, and again, in simple terms, it's plus or minus 5, right? So if the average rate of return is 10, that means, some points it makes 5% and some points it makes 15%, right? So it's the movement to get there. The other one that also averages 10% but has a 10% standard deviation would mean that it could be 0 to 20. So a lot more variability around that same average rate of return. Those are two pretty different investments, and standard deviation is actually a really critical component of portfolio design, at least in my opinion. And so trying to create, because consistency is one of the hallmarks that my clients are asking for the most part. So that's one of the things we look at. It's why I don't invest in cryptocurrencies. I don't see yet, I don't, at least in our portfolios here, I don't see diversification potential yet. And I see high standard deviation that would probably drive my clients crazy. So, but yeah, that's how it works. It's a good question.
So this is kind of where should I invest? It's should I make after tax contributions to my IRA? So it seems like they've maxed out their 401k and they're looking for where can they put their extra money.
Yeah, that's a good question. So obviously, you've done your 401k theoretically in that question. You've got your full match coming in. Maybe you've maxed out your 401k, and so now you're looking at, where do I got some extra savings. And so I could put money after tax. So it means I don't get the write off when I put money in that IRA. And then it can grow tax deferred thereafter, right? Um, I don't like that solution. I hardly ever see it anymore, and mainly because it's a real pain to deal with. You've got this IRA that's got this mixture of after tax and before tax. You can get around that, I believe, by probably opening another IRA to a certain degree. But I think from an accounting standpoint, you got to remember that for the rest of your life. How much of that is after tax? I hardly ever see it anymore. We used to see it, but now we don't see it as often. And I just don't think it's the best solution. What you're trying to do is put money away and let it grow tax deferred. So one way to do that, again, I don't consider it maybe the best solution, but you could do a very inexpensive no load annuity, variable annuity. And you could then get that grows tax deferred also. And it's a separate account. You've got choices you can do with different investments. You can buy some of these Vanguard funds and different things along those lines inside of some of these annuities. Fairly low cost, and there's no lockup. It's a no load. There's no penalties or anything. That's a better solution to me than an IRA after tax, in my opinion. Although I consider this last one the best solution, I would make sure that I'm still building up some of my taxable accounts. So there's three buckets that we really look at, kind of taxable. There's accounts that when we move things, we have to account for it and pay taxes on it. But it's capital gains tax, which is lower than ordinary income. If you put money in an IRA and take money out, you're taking it out with ordinary income tax, which is higher. If you put money in an annuity and you take money out, any gains are taxable at ordinary income. If I leave it in my taxable accounts, trust, individual, TOD, transfer on death accounts, those are taxed at capital gains rates. And so I'm a huge believer in having kind of the three buckets filled, as much as possible. Taxable accounts, tax deferred, like IRA, 401k, and tax free, like a Roth. And so if I have extra money and I'm maxing out my 401k, I might be thinking about putting that just in my taxable account and building that up because that's my liquidity. I can get at that a lot easier in my retirement. And I've run across way too many people who don't have enough money in their kind of taxable accounts during their retirement. And it's really hard to build that up after, you don't have a job anymore. It's still possible, but not as easy. So heading into retirement, if I had a choice in that question, I'd be putting that after tax money into taxable accounts, which I don't think anybody advises that. It's kind of amazing to me, but I've seen the logistics at the end. my average client is 74, and I've been able to see kind of what they're dealing with and how that works. And I just see these scenarios where people have more of a balance between their taxable, tax deferred, and tax free, and they're just better off. There's just a lot more flexibility when they change tax laws. They've got all the tax laws covered, one way or another in those three scenarios, and it could benefit one side and disadvantage another, but they don't have everything in one area, and that kind of stuff, and they're not susceptible to some of these things. So anyway, that would be my solution instead of after tax into an IRA, which I would put at the bottom of the list.
Yeah, and then if you with after tax to an IRA, if you ever try and convert that, you're it's adding to the headache because
Yeah.
I think the IRS calls it a coffee and cream. When you
Mm-hmm.
mix it all together, it's one thing. And so you have to do it pro rata rather than I can withdraw the after tax contributions only and then
Yeah,
convert that as, so you can't, there's no control over that when you
that's
do
right.
conversions.
Yeah, exactly. Yeah, I've had to deal with a few of those, and they're uncomfortable, honestly. The calculation aspects, the fact that you can't just take the tax after tax out first, you have to take it out pro rata. So if 10% of it is after tax and 90% is tax deferred, every $10 that comes out, $1 is the after tax, the other nine. It's just a mess. I would not do that personally.
So this is an investing question. Is is investing in energy a good idea with the rising like oil prices?
Yeah. So there's two energy ETFs that I really follow and like, and have used over the years. XLE is one of them. It's a Spider, which is State Street, and that is buying the energy companies on the S&P 500. So they kind of carve out those energy companies, um, mostly Chevron and Exxon. Actually, that's because it's a cap weighted piece, and those two are the big companies in there, but several other companies. And then there's Vanguard's VDE, Vanguard Energy, and ticker symbol there. And what that does is buy basically every energy company on the market. That's kind of Vanguard specialty. They do these broad based indexes. Both of them are quite reasonable in internal expenses and all those types of things. And so, if you look at what happened last year, those would have been two great investments to own for the full year. Energy did really well. I believe in the 11 spider pieces of the S&P 500, I believe XLE was the highest return. I could be wrong on that, but I think it was up there. And so what often happens with that energy when we start to see economic growth is energy is getting used more. And so you'll see this, increase in oil prices, and that means higher profits for these companies because, they're a lot of their exploration costs might be sort of fixed, and transportation costs and refinery costs might be somewhat fixed, and it even go down with volume. So, higher price works. The one thing I worry about with those a lot is that it's not. Take the semiconductors, for example, which is where I've been investing more lately. Even though that hasn't worked out so great so far this year, I still think it has some great, great potential because there's great demand during economic expansion, kind of like we're seeing now. But it's very difficult to make new semiconductor plants, and new semiconductor companies aren't coming into play all the time. When I look at energy, that some of the big oil producers like the Saudis can just start to turn up the amount of production they're doing and drive prices down sort of at their whim. And they even have an incentive to do that at some point in time because when oil prices get higher and higher, they make more profit, but it brings in all these new competitors that have higher costs of exploration. So, especially here in the US, we have a higher cost, labor cost mainly. And so when the prices get really high, all of a sudden, all these US people, all these US companies can start producing here in the US, and that takes market share away from the Saudis. And so if they turn their spigots on, so to speak, and drive the price back down, they can take all those competitors out. So they have a vested interest to kind of keep a certain price in play, in my opinion. That's what I've seen in the past. Doesn't seem to be happening right now as much. And I'm not an expert at energy, but it's sort of a weird dynamic. I really don't like where somebody else can control that supply at their whim. I would prefer to have something like semiconductors where the supply is very challenged to grow, and the demand is continuing to come in, and there's more and more semiconductors coming needed constantly every product seems to be coming out now has some kind of semiconductor in it, and so I think that drives profits, right? And we saw that with a lot of these companies that are reporting are reporting really good earnings and making very good statements about what they see in the future. So I like that tight supply that has a much harder time growing. Um, to a certain degree. There's some problems with that, but I prefer that over a situation where some unknown entity, can just start producing tons of oil, or even, different countries that are currently kind of banned from producing oil, like Iran, all of a sudden are allowed to produce oil, and they start to flood the market. And the supply part of that is really weird to me. So I still think it's a good investment. I have no problems with people that want to do it. I think it's definitely worthwhile, but that's what, and certainly has paid off last year, that's for sure. But that's one of the issues that I see with it that always makes me a little bit nervous.
Another question, just how does like rising oil prices affect just the overall economy and market?
Yeah, theoretically, rising oil prices is a drag on the economy, right? Because companies are having to pay more. It's just like wages go up, and different pieces go up. It drags on the economy, and drags on earnings potential, right? So companies that are using energy in some form or fashion have a higher cost. Some companies are more than others. Airlines use a lot of gas for their airplanes and that kind of stuff, and so. It's a sign of an improving economy when you see it coming up, assuming there isn't some supply shenanigans going on. Like they can cut back too. They can cut back on their production and drive up the price. But we saw the price of oil go down dramatically in 2020. It even went negative on one day, which is mind-boggling. Actually, I don't think that had happened before, where the cost of storing oil was higher than what you could get per barrel. So, and whoever bought at that point, probably made some pretty good money because it's now at $84 a barrel. So, I think overall that's what's going on with energy as far as the economic impact. It's definitely something worth watching. It's something I watch all the time because I think it's important as far as that goes. But it goes up with the economy, down with the economy, and it can slow down the economy if it gets too high. Right? It can be its own drag, sort of like a Federal Reserve raising interest rates, actually.
Yeah, that's good to know because like when I look at gas, when I go and pump my car up, it's like it's kind of crazy now what it was
Yeah,
compared to a couple of years ago.
yeah, yeah. And that's a drag on your pocketbook. You might not go to the movie or something because of that, or whatever it might be. And that's a drag on some business somewhere, right? Because money's being diverted from that other business to that gas pump. Yeah.
So one last question is, when should I buy the dip versus get out of the market?
Yeah, that just it was funny for a while there, that because the retail investors have been really, really big on buying the dip and lots of articles about it and different things. And, they talk about that a lot with cryptocurrencies, buy the dip. And somebody made some joke about, well, they didn't tell me it was a 7 layer dip, because sometimes these things keep going down. So, when you look at the stock market, I think it's pretty straightforward. And that really is the situation where, the again, looking at the averages. So the average downturn without a recession is negative 15%. The average downturn with a recession is negative 36%, right? That one stat alone should kind of tell you what's going on. So when I look at the leading economic indicators, which is one of my main sources of trying to figure out what's going on with the economy, and they're still going straight up and they haven't peaked out yet, that means that a recession is a little ways away, at least, if not a long ways away. Historically, we haven't seen the leading indicators, going up and have a recession, except for what just happened with the pandemic. So an outside force can sometimes create a different situation, but um, I need to see the economy coming down and the stock market coming down. And once I see that, I don't want to buy the dip because I don't want to buy. That's a 12 layer dip. I don't want to go down 36%, keep buying and buying and buying. I'm actually going to go the other way. I might even take something off the table at that point in time. I don't, buying the dip in the 2008 downturn was a disaster, right? So that's not what you want to do, in my opinion. Um, Having said that, now if we don't have an economic situation and we do have a stock market downturn, that has averaged negative 15. I can handle negative 15. I want to buy on the way down. And the way we do it is rebalancing the portfolio. And so we just kind of continue to rebalance. And sometimes, that means the bonds didn't go down as much as the stocks. And so we're kind of, selling a little bit of bond and buying some stock. We rebalanced 4 times this year. Those worked out really well, actually. It's been really good. So that's kind of the dip mentality, at least in my opinion. It works. It's fantastic. Most of the times it's going to work. We don't have these big downturns very often, but you do have to be a little bit careful. And I would definitely be paying attention to the economy, and I'd pay attention to earnings and see how that is being impacted by the economy, that kind of stuff. So I think it's a great piece of the puzzle. But okay, well, that's the end of the show altogether. I want to thank everybody so much for coming. Definitely enjoy doing this. Lots of good questions and thoughts, and hopefully this continues to help people. We're really big on education, so if you want to subscribe to the channel to continue to get updates on what we're doing here and hear about these different pieces, or you can set an appointment with us on our website. Again, go 30-minute phone or video appointment with Ethan and I, and we can answer your questions and see if there's something we can help you with. So look forward to seeing you next week, and I want to thank everybody for coming this week. Thank you.